Hello, and a massive welcome back to the Handsome Trader channel. I am your host, the Handsome Trader, and I am absolutely pumped for today's deep dive. We spend so much time in this community talking about strategies, about our wins, our losses. We look at the news, we look at the Fed, but there is this one debate that just never seems to die. It is the absolute elephant in the room of the trading world.
It really is. It divides people like almost nothing else in finance.
Exactly. I'm talking about the charts, the lines, the squiggles, the geometric shapes we all stare at for hours. Technical analysis, is it actually science? Is it a legit way to navigate the financial markets? Or, and let's be honest, we've all thought this at some point when a trade goes completely wrong, is it just reading tea leaves? Is it total voodoo designed to make us feel like we have control over the chaos? Well, today we're going to settle this. We're digging deep into the truth about technical analysis, scam, or the secret weapon of the pros.
It really is the question that can make or break a trading career. It's the big dividing line.
It is. And before we get to the good stuff, and trust me, we have some serious aha moments lined up for you today that might just change how you look at a screen forever. I have a small, sincere favor to ask. If you find any value in what we do here, if you want to support us in demystifying this crazy world of finance, please just hit that like button. Share this with a fellow trader who might be struggling, and make sure you're subscribed. It supports us with all your heart, and I truly, truly appreciate it. It helps us keep the lights on and the content coming.
It really does. It allows us to keep doing these deep dives.
Now, let me introduce my co-pilot for today. She is a veteran trader who has, truly seen it all. She's survived bull markets that made people euphoric and bear markets that made grown men cry. She specializes in trading psychology and has this amazing knack for making the incredibly complex sound simple. Please welcome our expert for today. How are you doing?
I'm doing great. Thank you so much for that warm welcome. I am genuinely excited to unpack this today because, like you said, there's just so much noise out there. You have people screaming that charts are everything, and then you have others saying they're absolutely worthless. I kind of want to create a bit of a safe harbor today, a place where we can look at the logic, not the hype.
I love that. A safe harbor is exactly what we need because, honestly, the skepticism is real. It's intense. If you talk to most academics or even some of the senior bankers in their ivory towers, they'll tell you straight up, technical analysis is nonsense. They say you can't predict the future by looking at the past. They'll throw out the efficient market hypothesis. So let's just start right there at the very beginning. Are they right? Is it all just nonsense?
Well, the short answer is they are right about one thing and they are dead wrong about everything else. It works, but it only works if you understand what it actually is. The problem is that most people, and even some of those academics, think technical analysis is some kind of magic. And it's not magic, it's logic.
Logic. Okay, let's unpack that. Because when I first started out, I definitely thought it was a little bit magical. You draw a line on a chart and you just pray the price bounces off it. It felt like I was trying to cast a spell on the market or something.
Right, and that's the trap. That is exactly where that scam feeling comes from.
So let's redefine it then. What is the biggest misconception? I feel like we all see these gurus on social media drawing these random triangles on a chart and predicting that, I don't know, Amazon is going to be exactly $154.20 next Tuesday at 2 p.m. Is that what we're talking about?
Absolutely not. And that right there is why so many people fail. The biggest misconception, hands down, is that technical analysis is a crystal ball. It is not prediction. We're not forecasting where the price will be next week or next month. If anyone tells you they know for a fact where the price will be next week, you should run away. They're either lying to you or to themselves.
Wait, hold on a second. If it's not prediction, then what in the world are we doing? Isn't the whole point to know where the stock is going? If I'm sitting on my desk for 8 hours a day staring at candles, I kind of want to know the future.
Not exactly. Let me ask you this. Do you play poker?
I have been known to play a hand or two. Usually badly. I lose my chips pretty fast.
Okay, well, imagine you're sitting at a poker table. You look down and you have your hand. Let's say you have a pair of aces. Now, do you know for a fact what the next card coming out of the deck is going to be? The river card?
No, absolutely not. It's a shuffle deck. It's completely random.
Exactly. It is random. The future card is totally unknown. But do you know if the odds are in your favor to play the hand you're holding?
Yes, for sure. If I have a pair of aces, I know statistically I'm in a way better position than if I have a 2 and a 7. I know that over 100 hands or 1,000 hands, the aces will win much more often.
Precisely. That is technical analysis. It is simply determining when the probabilities favor a trade. You aren't predicting the next card. You are assessing the strength of your hand relative to the pot, to the other players. We are studying charts, looking at price, at volume, at time to identify behavior that is non-random. We are just looking for the pair of aces.
That is a really, really powerful distinction. So we aren't trying to be fortune tellers with a crystal ball. We're trying to be the casino. We are playing the math. We're the house.
That's it. We're looking for those moments where the behavior of the market isn't just noise, but it's a recognizable pattern. And this is where it differs completely from, say, fundamental analysis.
Right. Fundamental analysis is the Warren Buffett stuff. Reading balance sheets, checking the PE ratio, seeing if the company is actually making money, looking at the CEO's track record, all that.
Exactly.
Hmm.
Fundamental analysis asks, what is this company worth in the long run? And technical analysis, frankly, doesn't care about the PE ratio. It doesn't care if the company is overvalued or undervalued in the long term. It cares about the now. It cares about the struggle between supply and demand that is happening right this second. It's simply asking, how many people want to buy this thing versus how many want to sell it?
It's almost like fundamental analysis is the grand strategy, like the long war, and
Mhm.
technical analysis is the tactics. It's the battle happening right in front of you.
That's a beautiful way to put it, a perfect analogy. You could be right about the war and still get killed in the battle if your tactics are wrong.
So the goal isn't to be right all the time.
No trader is right all the time. It's impossible. If you try to be right 100% of the time, you will go broke. I guarantee it. The goal is just to find moments of positive expected value, to make an educated guess based on patterns that show us the odds are tilted, even just a little bit, in our favor.
Okay, I like that. Positive expected value. It sounds very professional, very serious. But let's get into the nitty-gritty. You said it's not magic, it's logic. But I have to be honest, when I see a price drop and then stop exactly, and I mean to the penny at a white line I drew on my screen an hour ago, it feels a little bit like magic. Why does that happen? Why does the price stop there? Is the market listening to me?
It definitely feels like magic, but it's actually just market structure. And market structure is just a fancy Wall Street term for supply and demand.
Okay, demystify this for us. Take us behind the curtain. What is really going on there?
Let's break it down to the human level, because that's all the market is. The market is just people. It's buyers and sellers. It's not some abstract machine. It's a collection of human decisions. Now, imagine a scenario. Let's say there's a massive institution, a mutual fund, a hedge fund, a pension fund. Let's just call them big money.
Right.
And this fund needs to sell a huge amount of stock. Let's say they have 5 million shares of XYZ Corp, and for whatever reason, they need to get out.
Okay, so they are a big seller, a whale, a market mover.
A whale, exactly. Now, they can't just log into their brokerage account and hit sell all 5 million shares at market. If they dumped all that stock at once into the market, what would happen?
The price would totally crash. They'd wipe out every single buyer in the order book. They'd get a terrible price for their own shares because they would literally push the price down with their own selling.
Exactly.
Yeah.
It's called slippage, and it would cost them millions. So they have to be smart about it. They have to be stealthy. They sell in chunks. They use complex algorithms. They might decide, okay, our strategy is every time the price hits $100, we are going to sell 10,000 shares.
So they put a cap on it. They set a limit for their algorithm.
Right. So the price rallies up, it looks good, everyone's buying, it hits $100, and boom, the whale's algorithm triggers and sells a chunk. The price dips because that new supply hits the market. Then the market rallies again. People think, oh, it's going up. It hits $100.
Yeah.
And the whale sells again. The price dips. Again.
And the smaller traders, the sharks and the minnows, people like us sitting at home, we're watching this happen on our chart.
You're watching. And you start to notice a pattern. You say, hey, wait a minute. Every single time price gets to $100, it gets smacked down. It can't seem to get above $100.
So I start thinking, well, if it can't get past 100, I probably shouldn't be buying there. In fact, maybe I should be selling there too.
Exactly. You and thousands of other traders see this ceiling. So you start selling before it even hits $100 to make sure you get your order filled, maybe at $99.90. This creates a wall of sellers that is resistance. It isn't a magic line drawn by a wizard. It is the footprint of a big seller and the rest of the market reacting rationally to that seller.
Wow, that makes so much sense. It's visible evidence of a huge order being filled over time. It's like seeing footprints in the sand. You don't see the person who made them, but you know for a fact that they walked there.
Perfectly said. And it works the exact same way in reverse. That's support. Imagine a big buyer, a pension fund, wants to own a massive position at $90. They think $90 is a bargain, so every time the price drops to 90, they step in and start buying up shares. The market sees that floor being created. The smaller fish see it and say, hey, it's not going below 90. So they start buying at $90.50 or $91. They try to front run the big buyer.
And that buying pressure from everyone else pushes the price up before it can even get down to the big guy.
Yes. So the key takeaway here, the big idea, is that technical analysis is just visualizing the rational reactions of all the market participants to these big buyers and sellers. You aren't trading the line, you're trading the behavior that created the line. The line is just the tool we use to see the behavior.
That is actually really grounding. It takes all the mysticism and the voodoo out of it. It's just supply and demand playing out in real time on a screen. But, here is where it gets really interesting for me. We are talking about rational behavior. Big banks moving money smartly, using algorithms, being careful. But people aren't always rational.
Oh, definitely not. People are messy, emotional.
I mean, I've been there. I have absolutely panic sold at the bottom. I've FOMO bought at the top because my neighbor told me about some hot stock. Does technical analysis account for when we all just lose our minds?
Not only does it account for it, but that is also arguably when technical analysis is at its most powerful and most predictive.
Yeah.
This brings us to the second big reason why it works: forced behavior.
Forced behavior, that sounds ominous. It sounds intense.
It is, for the person being forced.
Yeah.
We have to talk about the difference between a rational decision and a forced decision.
Okay, break that down for us.
A rational decision is something like, I think this stock is getting a little overvalued, so I will sell some and take my profit. That's calm. That's calculated. It's a choice. A forced decision is, oh my God, I have no choice. I must sell right now or I am going to lose everything.
We're talking about leverage here. We're talking about borrowing money to trade bigger.
We are absolutely talking about leverage and margin calls.
Yeah.
This is the jet fuel for the fire. When traders borrow money to trade, which is very, very common in futures, Forex, and even with stocks, and the market moves against them, they get into trouble very, very quickly.
Right. If I buy a stock on margin and it drops 20%, my broker isn't going to just pat me on the back and say, hey, better luck next time, handsome trader.
No, they are going to issue a margin call. They will call you or send an automated alert telling you to deposit more cash into your account immediately. And if you can't, or sometimes even if you try but you're too slow, they will start selling your position for you to cover their loan. And here's the key. They don't care about the price. They don't care about your chart. They just hit the market sell button. They liquidate you.
And that creates a feedback loop, doesn't it? A domino effect.
A massive one, a vicious one. Imagine a stock is falling. People are already getting scared. Then the first wave of margin calls hits. Those traders are forced to sell. That sudden, price-insensitive selling drives the price down even further and faster, which then triggers the next wave of margin calls for the people who had slightly deeper pockets but are now in trouble too.
It's a waterfall. Selling triggers more selling. It's a cascade.
Exactly. It's called a liquidity cascade. And this panic, this forced selling, leaves very clear signatures on the chart. You see an acceleration in the price movement. It starts dropping faster and faster. The candles on the chart get longer and longer. You see huge, enormous volume spikes. That's the capitulation, the get me out at any price moment. You see these big percentage moves that just don't make sense fundamentally.
And as a technical trader, you can see that happening in real time. You can actually identify the panic on the screen.
You can. Technical analysis helps you spot these emotional extremes. When you see that vertical waterfall drop on massive volume, you know it's not rational selling anymore. It's forced liquidation. And strangely enough, that is when the market is the least random.
Because fear makes everyone do the exact same thing at the exact same time.
Bingo. Fear is a great unifier. In a normal, choppy market, some people are buying, some are selling. It's all over the place. It's random. But when everyone is running for the exit door at the same time, the direction is incredibly predictable. Everyone is selling. TA gives you the tools to structure a trade around that panic, to maybe even be the one buying when everyone else is being forced to sell.
It's like being the only calm person in a burning building looking for the fire exit while everyone else is stampeding. Or maybe it's like waiting for the fire to burn out and then buying the building for pennies on the dollar.
Exactly. You are looking for the fire sale.
Ew.
But you need the chart to tell you when the fire is actually out. You don't want to try and catch a falling knife. You wait for the selling to exhaust itself.
Even better. Okay, so we have market structure, the whales and their orders. We have forced behavior, the panic, and the margin calls. But there's a third layer to this, right? It's not just about force, it's about feelings. It's about the emotional journey of the average trader.
Yes. The third big reason TA works is simple, fundamental human psychology. You have to think of charts as essentially emotional maps.
I love that description. Emotional maps. What does that look like on a screen? I mean, how do you map an emotion like regret or hope?
Well, every single price point on a chart represents a transaction where someone bought and someone sold. That means at every price level, there are human beings holding positions with real emotions attached to them. Every candle, every bar is a memory, a collective memory.
Okay, walk us through an example. Make it real for us.
Let's use what I call the average holder concept. Imagine the stock was flying high at $600. Everyone loved it. It was on the news every night. People bought at the top because of FOMO, the fear of missing out.
We have all been there.
Right.
I think I bought a few tech stocks right at the peak in 2021 because I didn't want to miss the party.
We all have. So you buy at $600. Then the party ends. The stock crashes down to $400. Now, I want you to put yourself in the shoes of the person who bought at 600. How are you feeling right now with the stock at 400?
I feel terrible. I feel stupid. I'm full of regret. I'm praying. I'm bargaining with the market gods. Just let it go back up, please. If it just goes back to what I paid, I promise I'll never be greedy again.
Exactly. You are in pain. You are holding a very heavy bag. Now, consider the people who are just now buying at $400. They're fresh. They're hopeful. They see a bargain. They're excited.
So you have two distinct groups of people with totally different emotions. One group is in pain and just wants out, and the other group is excited and wants in.
Right. Now, imagine the stock starts to rally. It goes from $400 back up to $500. It's halfway back to the old highs. What happens to the guy who bought at 600? How's he feeling now?
Well, I'm still down, but I'm down less. I see the loss shrinking. The pain is easing a little.
And for a lot of people in that situation, the psychology shifts from, I want to make a profit, to, I just want to get out alive.
Mm-hmm.
They say to themselves, if I could just get a little bit closer to my entry price, I'm selling. I'm getting out.
Oh, totally. It's the break-even psychology. It's so powerful. If it gets close to my entry price or even just halfway back, I sell just to stop the pain. I just want my original money back.
That's it. And that selling pressure from all those trapped holders trying to escape their painful position creates resistance. Technical analysis helps us visualize where those bag holders are trapped.
Mm-hmm.
We can look at a chart and say, wow, there was a lot of volume traded up at $550. If the price gets back there are going to be a lot of people who are just grateful to sell.
That is absolutely fascinating. So the chart isn't just data points. It's a history of pain and relief. It's a story.
Precisely. And this leads us to one of the most useful indicators for seeing this, which is VWAP.
VWAP, volume-weighted average price. I see this line on the screens of every pro trader I watch. I see it on the institutional terminals. Why is this one so special?
Think of VWAP as a simple proxy for how the average person feels who bought during a specific period, like that day or that week. It calculates the average price paid for the stock, but it's weighted by how much volume was bought at each price. So it's the consensus price, where the most business was done.
Okay, so it tells us where the market center of gravity is for that day.
Yes. And it's incredibly simple to interpret. If the current price is above the VWAP, it means the average holder for that period is in profit. They're happy, they might get greedy, they feel like they are winning. They are under no pressure to sell.
And if the price is below the VWAP,
Then the average holder is losing money. They are underwater. They are scared. They are desperate. If the price rallies back up to the VWAP, they will often sell just to get out at break even. That's why price so often seems to bounce off the VWAP line and turn back down. It's not magic. It's just the collective sigh of relief from people getting out at break even. Trading is essentially navigating these waves of feelings. When you understand that, you stop fighting the chart and you start understanding the narrative behind it.
that is such a cool way to look at it. It's like a form of empathy. You're empathizing with the pain and greed of the other market participants.
In a way, yes, a very profitable form of empathy.
I'm going to use that one, profitable empathy. I like that a lot. Okay, so we've covered the logical reasons, supply and demand, forced liquidations, human psychology, but I have to ask the skeptic's question. The big one, the chicken and the egg question.
Go for it. Ask the hard one.
Does technical analysis work simply because everyone thinks it works? Is it just a massive self-fulfilling prophecy? I mean, if everyone on the planet looks at the 200-day moving average, does that line become important just because we are all staring at it?
The honest answer? Yes, partly.
Uh-huh. I knew it. I knew there was a trick. It's all a mind game.
But that doesn't make it fake. In fact, it makes it one of the most powerful forces in the market. This is the fourth reason it works. We can call it the because we all look at it theory.
Okay, explain how that functions. Why is that a good thing and not a bad thing?
It all comes back to risk management. Think about it. Even the traders who hate technical analysis, the ones who say it's voodoo and nonsense, they still need to manage their risk. They need to have a point where they admit they are wrong and get out of a losing trade. They need a stop loss.
Right. You can't just hold and hope forever. You have to protect your capital. That's rule number one.
So where do they put their stop? Do they pick a random number like, say, $102.37? No. That's arbitrary. It doesn't make any sense. Humans crave structure. They crave logic. So they pick obvious logical levels.
Like just below the recent low or just below that big round number like $100.
Exactly. Or just above the recent high. If you are shorting a stock, betting it will go down, you put your stop loss just above the highest point it reached recently. Because if it breaks that high, your whole thesis for being short is probably wrong.
So because that is the most logical place for everyone to put their stop.
But millions of people and billions of dollars in algorithms place their exit signs at the exact same obvious spot. Becomes a magnetic zone. It creates a giant pool of orders, a pool of liquidity sitting right there.
The herd effect.
Yes. And when the price hits that level, say it breaks just above that recent high, what happens? All of those stop loss orders from the short sellers trigger all at once. And remember, a stop loss for a short seller is a buy order. You have to buy the stock back to cover your short position.
So a massive flood of buy orders hits the market instantly and automatically.
Which shoots the price up even higher and even faster.
Which then triggers the stops of the people who set their stop a little bit higher.
Exactly. It's another cascade. So, does the level work because the line was magic? No. It works because the line was obvious. And as a nimble trader, you can predict where the herd will be forced to panic sell or panic cover, and you can structure a trade to profit from that structural predictability.
So you're essentially front-running the inevitable reaction of the herd. You know where their pain points are. You know where they are hiding their exits.
You are utilizing the shared language of the market. If everyone in a room agrees to speak English, you don't show up and start speaking French and hope to be understood. You speak English. If everyone in the market uses charts to define their risk, you use charts to anticipate their risk. It's a giant coordination game.
Wow. That is a mic drop moment right there. The shared language of risk. I love that. It makes so much sense. We are all just agreeing on the rules of engagement, and the map we use is the chart.
But, and this is a huge, huge but, we have to talk about the trap.
The trap. I feel like this is the part where you tell me why I'm not rich yet.
Well, maybe. The question is, if it's this logical, if it's just supply and demand and psychology and risk management, why isn't everyone printing money? Why do so many people fail at this? Why is the failure rate in trading so high?
That is the million-dollar question, for sure.
The answer lies in where you apply it. The biggest mistake that new and even experienced traders make is applying technical analysis to the wrong charts.
What do you mean by the wrong charts? A chart is a chart, isn't it? A candle is a candle.
Not at all. Not even close. Most of the time, for most stocks, the market is incredibly efficient. It's random. It's boring. It's just noise.
Low volatility, nothing happening, just chopping sideways for days.
Right. Think of a massive, stable utility company stock that moves 10 cents a day, or a random penny stock with no volume where literally nobody is trading.
Yeah.
Technical analysis does not work on boring, random, low-volume charts.
Why not?
Because there is no emotion. There's no forced behavior. There's no herd to analyze. It's just noise. It's just a few algorithms pinging back and forth. There's no story to read.
So the academic studies that come out every year saying TA is garbage and no better than a coin flip
Are often testing these patterns on a random basket of stocks in random market conditions. It's like trying to surf in a swimming pool. You can have the best surfboard in the world, the best technique, and the best balance. But if there are no waves, you aren't surfing. You're just floating there looking silly.
That is a brilliant analogy. You can't surf in a swimming pool. So what are the waves? What are the winning conditions for a technical trader?
You need chaos to find the order. Technical analysis works best when there is high volume, high emotion, and big price ranges.
You need the stock to be in play, as they say.
Exactly. You need a stock that is in the news, that just had earnings, that has some kind of catalyst. When millions of people are watching it, when greed and fear are at their absolute peak, that is when human behavior becomes predictable. That is when the patterns form clearly.
So if I'm trying to use some complex head and shoulders chart pattern on a stock that trades 500 shares a day, I'm just wasting my time.
You are absolutely flipping a coin. You need the liquidity and the psychology to make the patterns valid. You need the crowd. You can't analyze the psychology of a crowd if there is no crowd.
This really explains why my early attempts to day trade sleepy dividend stocks with fancy patterns never worked. I was looking for patterns where there were no people. I was trying to start a fight in an empty room.
Exactly. You need the conflict. You need the battle between buyers and sellers.
So let's bring this all together. We've covered the mechanisms, the psychology, the conditions, but how does a professional actually think about this day to day? What is the core mindset?
The mindset, when you strip everything else away, is all about expected value, or EV. It's thinking like the house, not the gambler.
The casino mindset. Back to that.
Yes. A casino doesn't know if it will win the next hand of blackjack. They don't care. They don't sweat that one hand. But they know with mathematical certainty that over 1,000 hands, or a million hands, they will make millions of dollars. Why? Because the odds are just slightly in their favor on every single hand.
And they manage their risk. They have table limits. They don't let you bet $1 billion on one hand and wipe them out.
Exactly. The formula for a long-term career in trading, it's actually quite simple to say, but very, very hard to do. It's three things. One, be right more often than random. You don't need to be right 90% of the time. Even 55 or 60% is Hall of Fame level in trading. Two, when you are wrong, and you will be wrong, a lot, lose a little. Keep your risk tight. Cut the loss fast and without emotion. And three, when you are right, make a lot. Let your winners run.
It's all about the asymmetry, making sure your winners are bigger than your losers.
Yes. And technical analysis is simply the framework to find those setups with good asymmetry. It defines your risk. It tells you if price drops below this support level, my thesis is clearly wrong, and I get out for a small, manageable loss. Without the chart, you're just guessing where to exit. With the chart, you have a logical invalidation point.
So it's not about knowing the future. It's about structuring the present so that if you can just survive the losses, the wins will eventually take care of you.
Perfect. That is it. It is a structure for intelligent risk-taking in an uncertain environment.
This has been incredibly enlightening. I really feel like we've stripped away all the voodoo and revealed the machinery underneath it all.
That was the goal, to show the logic.
So just to recap for everyone listening, technical analysis isn't magic. It's a study of market structure, that's supply and demand. It's identifying forced behavior like liquidations and margin calls. It's reading the emotional map of the average holder to see who's in pain and who's happy. And it's understanding the self-fulfilling nature of where everyone agrees to place their risk.
And, most importantly, remembering that it only works when there are waves to surf. You need high volume and high emotion.
Man, I really wish I had known all this 5 years ago. I spent so much time looking for the holy grail indicator that would never be wrong. I was looking for magic. I should have been looking for logic the whole time.
Don't beat yourself up. Every single trader goes through that phase. We all start out looking for the magic wand. The real graduation day for a trader is when you realize the magic is just probability and discipline.
Well said. Now, before we sign off, we do need to be serious for just a moment. We talked a lot about money, markets, and trading today, and I want to make sure everyone listening understands the rules of the road.
We have, and this part's really important.
So here is our official disclaimer, and please listen closely. The content in this video is for sharing knowledge and personal experience only. It is not investment advice. Financial investment always carries risks. Viewers need to do their own thorough research and take responsibility for their own decisions.
Absolutely. Protect your capital above all else. Do your homework, and never, ever trade with money you can't afford to lose.
Thank you so much for joining us on the Handsome Trader channel today. This was an absolute blast.
It was my pleasure. Trade safe and keep learning.
And to all of you listening, thank you for hanging out with us. If you learned something new, don't forget to smash that like button. We will see you in the next deep dive.